Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Yesterday, my colleague Mena Abraham and I, Mena looks after our tax and business advisory part of Pro Solution. We recorded a presentation on YouTube and I thought I would share it here. So without further ado, let's get into it. Okay, welcome. My name is Stuart Weems and joining me is my co-host from the Holistic Accountant podcast, Mena. Welcome.
Thank you, Stuart.
It's been a pretty busy 40 hours since the budget landed, as you can imagine. Mena's been very, very excited. He gets overexcited about anything about tax. So it's great to have him here today, and it's great to have you here today as well, listening in. Of course, it has only been 40 hours, so there's a lot of water to go under the bridge before we as investors make decisions in terms of the advice we give our clients and I guess the decisions you make as investors. So we've got to keep that in mind. During today's session, we've got a lot to get through, as you can imagine, but we would love to receive your questions. So if you have any questions, we'll try and get to them throughout the presentation, but please do ask your questions. It'll shape even further or future presentations. So let's start off by, I guess, talking about the budget very generally. And I always want to be apolitical, so this is not going to be a political statement. I'll leave that commentary certainly to other people. But the rhetoric around the budget was really about creating intergenerational fairness and helping housing affordability. And according to KPMG's numbers, additional tax revenue receipts are projected to increase by $126 billion over the next 4 years, but spending is projected to increase by $129 billion and net debt to increase by about $220 billion. So this budget isn't about intergenerational fairness, as we'll talk about today, because we don't expect it's really going to change the landscape. And it's certainly not about housing affordability. It's about raising tax revenue, which shouldn't be a surprise to anyone. That's what governments do. Both sides of governments will raise tax revenue at the same time, but it's good to sort of cut through this because we don't want to distract the debate away from, what they think or what they're selling to us, the benefits are. Also, the thing we've got to think about carefully is flat tax rates. That's why we've got a marginal income tax rate system, because it does create unfairness. So, anyone with significant wealth in a family trust or significant wealth generally is probably going to pay an average tax rate of greater than 30%. It's not a big deal for them. But think about a mum and dad self-employed person running a small business, trying to make ends meet. They earn $200,000 a year. Moving forward, if these proposals go through, they'll pay $60,000 of tax. Previously, they would have only paid $45,000 of tax. That's a 1/3 increase in the amount of tax payable to people arguably you would argue is Labor's sort of core cohort, if you like. So, there are going to be some problems with what is being proposed, some substantial problems, and that's why I think we as investors don't need to sort of overthink it at this stage. I think there's, as I said, a lot of debate to occur and so forth. The final thing I will say before we get into today's content is that New Zealand banned interest deductibility for investment properties in 2021, and they reinstated it, phased it back in beginning 24 through to 25. Now, it's really difficult to pull apart and work out what happened in New Zealand to try and draw a conclusion what might happen over the next few years, because, of course, as you know, hopefully probably remember, you had COVID during that period. That period began with very low, almost zero interest rates and ended with very high interest rates, as well as immigration, work from home, all the COVID impacts. So impossible to pull apart, what happened there. But the government decided that it really didn't help housing affordability. It didn't help renters. And that's why the National Party reinstated interest deductibility, which, Mena, I think is a great segue to get into. Let's talk about, and that's what we're going to do today, is we're going to talk about negative gearing first. Mena, so let's start there.
Yeah, perfect. So a lot to unpack there. And before I want to start, I just want to say that these are all just announcements. Nothing's law yet. So there's no need to jump ship or sort of, make any sort of transactions that are unwarranted just in the hope that these sort of laws will pass.
Yep.
So really the first change is around the existing property. So with existing property, if you've got an existing investment property, you're lucky, the rules are grandfathered, you can continue claiming the negative gearing. Nothing changes from that front. That also applies to your owner-occupier home. So say hypothetically you've got a home at the moment that you're looking to potentially upgrade in sort of 5-10 years or whenever it is. Now, because that home was purchased before budget night, the way that the proposal works at this point in time is that home is you can still negatively gear. So we're advising our clients at the moment to just put any excess funds in an offset account rather than any redraw or pay down the loan, just to preserve any interest deductibility you've got on that property. Going forward. Now, there is a transitionary period around till 1 July 2027. So if you've purchased a property between budget night being 13th of May to 1 July 2027, you can actually still claim the negative gearing up to 1 July 2027. However, those properties post 1 July 2027, assuming it's established home that is, can no longer be negatively geared. Now, there is a couple of carve-outs for negative gearing. The first is around new homes. So with new homes, if you've purchased a new home, so a home that's been, so think of like new townhouses or apartments where there's been more volume added to the existing land, then those properties can still benefit from the negative gearing. Similarly with commercial property, any commercial property acquisition, you can still claim any negative gearing associated with that. Now, finally, there's also around shares. So with shares, any sort of margin lending or anything like that, you can still claim deductions to invest in the share portfolio. So those are really the carve-outs for negative gearing. So, sure, I think you've done some modelling as to what this looks like from a percentage perspective around negative gearing.
Yeah, I mean, I guess that's the first thing, Mena, people are going to be thinking about is, what impact does it impact me as an existing investor or a prospective investor, if I'm thinking about buying another investment property. And, your point is very important in terms of we can't overreact on these things. It could change. So I don't think we need to make any decisions today, but the reality is that it will move the dial. Certainly the negative gearing situation and benefit dramatically changes the efficiency of investing in property. And it makes sense, right? Because we tend to go and borrow the full cost when we buy a property. So our contribution is the negative cash flow. At the moment, we get a tax deduction for that contribution. So it dramatically reduces, particularly if you're on the highest marginal tax rate, dramatically reduces the amount of negative cash flow that you've got to stump into. But if we don't get it, all of a sudden we've got to put in twice as much cash into the property. But we're not necessarily going to get twice as much as capital gains, of course, particularly if we're in Melbourne. So, it does certainly move the dial. So let's just talk about a scenario where we've got 6.5% growth, we've got sort of 3% yield, which I think would be, every property is going to be different, but I think that's going to be reasonable assumptions. Well, if we have that situation, we've got a after-tax internal rate of return of 11%. So after all taxes, you're making 11% on your money. That's a pretty good return, right? You'll be happy with that.
Definitely.
If we factor in the higher CGT, that return drops by around 7% to 10.2%. It's not ideal. No one wants to donate any extra money to the ATO, but except you, Mena. But 7% isn't really going to, move the dial too much. Borrowing to invest in property is still going to be attractive. But here's the kicker: if you then overlay no negative gearing on top of that, it drops to 8.4%. So that's a 24% total decline in total return. So I think as property investors, we need to sit back and think, is 8.4% enough compensation for the risk? So, what are the risks? Of course, we've got higher tenants or more tenancy rules, which give rise to less control, higher costs. We've got the risk associated with borrowing, which obviously we put ourselves into a long-term commitment. We've got interest rate sensitivity. We think about cash flow cost associated with the property, maintenance. You can't predict those things. I mean, you can make allowances, but sometimes you can have, you've got to replace an air conditioner that you only just put in 3 years ago. Sorry, I'm just venting here. And these things, so that's not necessarily predictable. And then the time and energy that goes into managing property. So the question I put to listeners then is 8.4% after tax going to compensate you for that? Because you could put that money into super and you can do that very tax effectively. And if you have a look at most of the good industry funds over the last 10, 20, 30, 40 years, they've delivered, 8-ish%, 9%, some are 10%, and that's on an after-tax basis. And that's no investment risk. You've got no control over the asset necessarily like you do with property, but I don't know. I really think it actually moves the dial on investing in property and doesn't necessarily make it worthwhile. Now, of course, a lot of people are going to be thinking, what about, new build property? Should I invest in that? Well, it's kind of interesting. I guess, firstly, we shouldn't let taxation measures influence investment decisions. The first thing the first observation is these things can change. Like, they might change as proposed. And then, Elbow might lose the government in 2 years' time and they might get changed back. All of a sudden, you've made what is a 20, 30-year investment decision off the back of, a moving target. Tax is always going to change. Rules are always going to change. So we've got to resist the temptation to make decisions purely on that. Look, I did the numbers. If I assume, and I looked at some example properties for this, if I did the numbers and assumed a 3.7% gross yield, and let's go 4.5% growth, I think that's pretty aggressive, because what we're doing is we're buying a house and land package really on the outskirts of a capital city, and the livability of those properties is only going to reduce, because in Australia we cannot build infrastructure cost effectively and fast enough for that livability not to reduce. Anyway, I get about an internal rate of return of 11%, which is the same as what property is, investment grade property is today. So on the face of it, you would go, okay, it's a good proposition, Mena. But I think that there's going to be some really significant downsides to doing this. Firstly, and absolutely, as anyone that listens to the podcast will know, we're all into evidence-based investing and fundamentals. And those properties are located in an area where the fundamentals don't stack up. I'm buying an asset where there's an abundant supply of vacant land. That's not ideal. And that's not necessarily going to be ideal for capital growth as well. The other problem is going to be that me as the first owner of that property has some unique tax benefits that are unique to me. Those tax benefits won't pass on to the potential purchaser down the track if I go and sell that property. They're not going to get the negative gearing. They're going to pay the higher capital gains tax. So to what extent will prices reflect those unique tax benefits? Me as an investor, I don't want to prepay for them. And then if you have a look at what's happened over the last 20 years in Brisbane and Melbourne in particular, there's been a lot of high-rise development, 15 years ago that was sold off the plan. Victorians were buying apartments in Brisbane for $300,000 or $400,000 15 years ago, off the plan, sight unseen. If you speak to locals in Brisbane at the time, they were laughing their heads off, thinking these idiots are paying $300,000 to $400,000 for something that's not worth that amount. And similarly in Melbourne, happened a lot of Chinese buyers bought off the plan. 80% of the building would be owned offshore. Yep. Now, that doesn't happen anymore. But the thing is that developers and the people that promoted those sales, which would have earned commissions of $10,000, $20,000, $30,000 to sell these properties to their clients, they design the product for that exact purpose. It's not a product built to create long-term value. It's a product to create profit.
That's right.
And so I think we can do the numbers and we can look at these things, but we've got to factor those risks into it as well. So we can talk about other opportunities in the property market as well, because I think the question, Mena, will be then, well, what do you guys think about investing in direct property if these changes come through? Well, you could go to commercial property and go and buy a commercial property in a small town or something like that. I see a lot of that on social media. I'm going to do a podcast on that probably next month, but I think the yields, the cap rates that they're selling for are too thin. I don't think there's going to be any future returns. So, in summary, if these changes get enacted as proposed, I think there's more attractive opportunities for investors. But I mean, what about existing investors? What do you think they should do?
Look, I think, as an existing investor, if you've got a property that you're already negative gearing, there's nothing's changed from that perspective. Our clients would already have investment grade property. We don't think any sort of investment grade property will be affected by the negative gearing changes or the CGT changes. Typically, we tend to invest or have our clients invest in sort of areas that are highly owner occupied. So in those areas, there's a big demand for that kind of property. And if you think about the likes of the inner circle of, let's use Melbourne as an example, the inner circle of Melbourne, you draw a 7-kilometre radius around Melbourne, there's very limited supply. You look at especially areas in the eastern corridors where there's not much apartment supply and more houses. And end of the day, there's a lot of owner occupiers. They're not selling for negative gearing. They're not selling for CGT changes. They're just basically selling for the benefits of, upgrading the home or accessing equity or just downsizing. There's still going to be a large cohort of people that want to get into those areas. They're not really targeting the people that really need that negative gearing to invest in those areas from my perspective. So in short, if you're an existing investor, I would say just sit tight, don't do anything. Again, these changes or these proposals aren't law yet. A lot can change between now and when it goes to Senate. So if you're an existing investor, you're probably one of the lucky ones to just still have a property that you're either negatively gearing or a property that you can potentially negatively gear in the future.
Yeah, I would just say we understand that you're not able to pose questions, which is not ideal, but we're just trying to work through to change that. So apologies, but we did receive a whole bunch of questions, so I feel like we can certainly talk to them. I mean, a lot of people will be thinking, what is that going to do to property prices, rental yields, these sorts of things? And look, there's going to be a lot of self-interested commentary around this. I think I've already sort of seen a little bit of it, so it's good to get into the facts. If you look at inner city locations in capital cities around Australia, it's kind of surprising that you see about 50 to 60% of property is rented, so it's owned by a landlord. We only have to look to pre-85 CGT assets. If we come across, we have some clients every now and then have pre-CGT assets. No one is selling them, right? They're unique. And the same with property that's going to have negative gearing. Investors won't sell. I mean, some investors will just because it's circumstantial, but if left to, if it's their decision, they're going to hang on to it. So I expect that the volume of vendors will reduce. I mean, particularly if you look to Melbourne, there's been a lot of investors selling over the last few years for reasons that we've previously talked about in the podcast. I think that'll stop. But also I think by demand, obviously, from investors, which tend to represent about 30% of the market. At the moment, they're representing about 40% of borrowing capacity, just probably because of the other states are doing so well in terms of capital growth. So I think that'll disappear as well. So I think we'll see fewer vendors and fewer buyers, which will probably underpin prices. There's a lot of commentary around, it's going to skyrocket rents. The counter argument to that, Mena, is that if I own a property as an investor and I go and sell that property and an investor can't buy it, then an owner-occupier is going to buy it. So in that situation, we've got one less renter in Australia and one new owner-occupier. It doesn't really move the market. Now, that's true at an aggregate level, but of course it's going to be different in geographical locations. So I think we'll see some increases in rental income, some changes to property prices, but I think they'll be patchy. I think at an aggregate level, and certainly if you look at the Treasury modelling on this, Grattan Institute, a few other independent areas, they sort of say it moves at the margin, but it doesn't really change very much, which, as I talked about at the beginning of today, that's the whole point, right? They sold it to us is to try and help young people with housing affordability, but all the modelling says that it's not going to do that. Yeah. So I don't think it's really going to change very much. As I said, there will be patches, but I don't think it's really going to change very much. Except borrowing capacity, Mena, that's going to have an impact, isn't it?
Yeah, massively. And we talk about the young people having or trying to get access to property, and yet, the borrowing capacity, we're talking about increased rate rises, the fact that you can't negatively gear anymore. So the negative gearing component alone, we've modelled it out that it affects borrowing capacities by, 15 to 20%, I think it was. So that's a huge amount that you can't borrow. So on $1 million loan, that's $150,000 to $200,000 already wiped off your budget. And as we know, in most states, that's $1 million doesn't really get you a lot in terms of an investment grade property.
Yeah.
So I'm not sure this budget or these measures will actually help sort of first home buyers get into the market, especially with the current rate rises and the inflation and government spending and the employment figures the way they are. So I'm not sure it's really going to get to where they really want to, or in targeting the first home buyers or getting people into the property market.
And what about what would you advise clients if they're looking for a property at the moment, an investment property that is?
Yeah, first is sit tight. I wouldn't be doing anything. Secondly, I'll be telling them just be cautious. There's going to be a lot of noise out there around developers and new stock. We talk about a lot in our podcasts, our blogs here about what an investment grade property is. These new builds, like you mentioned before, typically don't meet that criteria. They've got very minimal sort of land value to it. Developers obviously focus on volume, so they want to get as much onto a block as possible. So they're not really great, and they're out in the outer suburbs. So stay away from those types of products. Stay away from that kind of noise. They're going to sell you the dream in terms of the negative gearing, the CGT discounts, and so forth. But from my perspective, I would just be telling people, sit tight. If you had a pre-approval in place and you wanted to invest or something like that, just wait it out. Let's see where this goes. I think a lot will come into fruition or light in the next few months anyway.
Yep.
There's been a lot of rhetoric in the news, a lot of pushback. So it'll be interesting to see what the government sort of backtrack on, as we've seen with, for example, the Div 296 with Super.
Yes. Yeah, they've got history here.
That's right. So they've backtracked on that. So I wouldn't be surprised if there's some measures in this budget that they sort of redact.
Yes, yeah. And I think that's good advice, Bennett, because I guess we always think about opportunity cost in terms of delay, and we don't want clients to procrastinate. That delay's too long. But I think if we put our plans on ice, if we're going to make some substantial plans about investing in property, which it's an expensive and big commitment. I think to park them for 3 to 6 months or even a year is not that big a deal, rather than rush into something. Make a decision based on what we know today, and then you've got to ask yourself, in 20 years' time, will you look back and reflect on 2026 and go, oh, I shouldn't have overreacted. I shouldn't have done something like that. So I think we're to keep it in context. I was talk about making long-term decisions, playing the long game. And I think in the face of significant uncertainty in respect to what the rules are, and also uncertainty of whether, if those rules are in place for the foreseeable future, whether it moves the dial in terms of whether it's going to be attractive to invest in property.
What do you think from an owner-occupier perspective, though, Stuart? Would you, if we've focused on investors, what would owner-occupiers in the current market want to do?
Yeah, I mean, it's really interesting. I guess it depends on what happens to property prices and your view to that. And I think it depends on where you're buying and what type of asset you're buying as well, and to what extent will that be affected by investor demand. But maybe that's a good segue into the CGT changes, Mena. Let's because we'll come back to that. Let's talk about those CGT changes. They're pretty significant.
They are significant. So there's again a lot to unpack here. We've got the pre-CGT assets, which I'll start with. I know not a lot of people have these, and if you've had them, you're quite lucky to have them. So basically, you still get the CGT exemption up until 1 July 2027. So what that means is you can still sell that property or that investment or whatever you had before 1985 up until 1 July 2027 completely tax-free. Now, anything accrued in terms of value from 1 July 2027 onwards, it will then attract CGT. So we're encouraging clients to basically get valuations if it's a property or similar or even a business. As at 1 July 2027, just to get that cost base reset and get confirmation around what that cost base looks like. This doesn't mean we necessarily are recommending to clients to sell assets as a result, because like I said, you still get the gain, the uplift from 1985 up until 2027 completely tax-free. So it's, no worse off. You're getting a complete market reset at 1 July 2027. Similarly, obviously the CGT rates are reducing from 1 July 2027 across all asset classes. So that's property, shares.
Increasing.
Increasing. Increasing. I wish decreasing. That would have been nice. Increasing from 1 July 2027. So we're seeing that a minimum CGT tax rate of 30% will apply. And that will be indexed from also you got either a minimum of 30% from 1 July 2027, or it'll be you can use the indexation method from there on as well.
Yep. So it's 30% of that indexation method. So
correct.
Maybe explain if I've got a property asset, for example, that I bought 10 years ago, and I sell it in 10 years' time.
Yep.
Maybe explain how that's going to work with the new.
Yeah. So basically, you'll still get the 50% CGT discount up until 1 July 2027, and then from 1 July 2027 onwards, you would basically get, assuming that's the end of your 10-year period. For the preceding 10 years, you'll then apply the new CGT laws. So that's basically either applying the indexation method or the 30%, whichever.
Yeah. It's index. It's 30. The indexation method works by indexing the cost base. So they'll index the cost base. The cost base will become, the market value at July 27. So they will need some pretty attractive high valuations, if you like. And then they will index that, of course, to CPI versus what you end up selling the asset for will be your gross capital gain, and it's 30%, minimum 30% of that gross capital gain. So that's how it's going to work. There's there is some misinformation out there in terms of, Treasury has done some modelling on CPI versus 50% discount. They made some comments to say that they had concluded that the CPI is equivalent to a 60% discount, and that is true if the asset doesn't return very much.
Yes.
So it really, whether you'll be worse off or better off, really depends on what is the capital growth of the asset, because it's really the difference between CPI, which I think longer term we can think maybe it's 3%, versus what the capital growth is post 2027. So if you only get 5% or 4% capital growth, actually the CPI methodology you'll be better off.
Yeah.
But if you're lucky enough to get 10%, that's obviously you're going to end up paying more capital gains tax. We've modelled it just looking at a sort of 7% capital growth rate, and sort of the effective rate is somewhere between 30 and 35%. Whereas today, Mena, people pay around 20 to 22%, depending on their circumstances, but you can sort of draw a circle around that. So
it's a 50% increase.
It's only a 50% increase. Yeah, it's not too bad.
It's not a tax grab, right?
The good thing is it's not going to skew capital allocation, because it applies across the board. I don't know if that's a good thing. It's a good thing in of itself, but the fact that it applies to all assets isn't a good thing. And certainly that applies to business, I don't think is a great idea. It doesn't really encourage people to start a small business, although there are some small business concessions that still are around.
Yeah, they're bringing through the loss carryback provisions that they introduced in COVID. which I think is good, where
Yep.
you basically can use losses that you accrued from early years, or profits that you accrued from early years, to offset those losses that you have, subject to your franking account balance, of course. And also the small business CGT concessions are still around, so they haven't changed those, which is great. Love to see them indexed though, Stuart. They haven't been indexed for a number of years.
No, they're pretty generous. I'm surprised they haven't cut them out as well, to be honest. So what do we do about CGT, the higher CGT? Well, as I said at the beginning of today, the internal rate of return for property drops from 11 down to 10.2%, so about a 7% reduction. Like I said, I don't think it's going to change the strategy. I don't think it's going to change the advice or approach. I haven't done the same numbers for shares. You know, one of the advantages, of course, investing in the share market, Mena, is I can sell incrementally. And from our perspective, that's been an advantage. If we enter into retirement and we need some money, we need another $50,000 a year, where we can sell $50,000 of an asset, unlike property where you can sell the whole thing, and hopefully then keep our tax rate pretty low and not pay too much CGT. Well, unfortunately, that opportunity has gone, which kind of pushes property and shares sort of closer together, except for the negative gearing, of course. But you know, if they can see the negative gearing. So what are some reactions, I guess, that existing investors should consider as a result of these changes?
Look, I think it's just made two things more clearer for us. I think it's shown that the two biggest asset classes, or two biggest sort of tax havens that we have, is basically your family home and super. So from my perspective, I think those are the biggest things you've got to really execute well on. Ensure that your family home's a really good quality asset, as well as focusing on super, getting funds in there and making sure you're investing in super regularly.
Yeah. And I've written a couple of blogs about that I coined live investing, a little bit of a tilt on rent vesting, which is the sort of strategy to put not all your wealth, but a lot of your resources into upgrading the family home, and potentially making friends with downgrading that family home in the future. And certainly the family home has kind of been a bit of a free kick from a taxation perspective. So, I think that strategy was good before the CGT changes, but it's even better post.
Yep.
And we've done a few podcasts recently, particularly talking about property investors, trying to move more of their wealth into super as they approach retirement, or maybe the first 10 years after retirement. Again, I think it highlights that. But for prospective investors, people are going to be thinking, I got a question on YouTube last night, I think it was, about, well, should we now invest for income? Should we chase franked dividends? I don't think so, is the answer. I think the answer still lies in compounding capital growth. The benefit of compounding capital growth is that I don't pay tax every year. I get the return, I get to reinvest that return. Now, sure, I'm going to pay 7% more in the back end, in 10, 20, 30, whatever years it is. That's not ideal, but it still makes compounding capital growth attractive. So I don't think it changes our approach to investing in property or shares. The property, of course, negative gearing's the big one, but if we're just isolating the impact of capital gains tax, I don't think it changes that.
Yep.
Okay, let's talk about family trusts, which was the third really big change in the budget. Maybe you can take us through that. That's a pretty significant one.
Yeah, I'll probably say it's probably the biggest one out of the three. I know a lot of investors are focused on negative gearing and the CGT changes, but the trust one is probably the most convoluted and will probably have the biggest sort of tax effect for a lot of people, especially if you consider how many people are self-employed in Australia and how many small businesses make up our economy. A lot of them will have trust structures in place. So from a family trust perspective, what they're essentially trying to do is basically do a minimum tax rate of 30% across the board. So basically, if we use the example that Stuart mentioned earlier around the $200,000 of income in a family trust from a business entity, typically we will distribute $100,000 to one partner and $100,000 to another partner, would yield about an average about $45,000 in tax as a result. Because of these new laws, it's going to be a flat rate of $60,000, and you don't get a tax credit for that additional 15% you've paid otherwise. So you're a lot worse off. And what they're also trying to do is reduce the ability for you to use a corporate beneficiary. So typically what we'd used to have is, say, a business in a trading trust and have a corporate beneficiary, so that we used to be able to distribute to, say, mum and dad or partners or whatever it is, up to, say, $190,000, $200,000 each, and then balance will go into a corporate beneficiary who usually can cap the tax rate at 25 or 30%, depending on what type of entity you are. And what that's done is now that those taxes are now at a flat 30%, but the company doesn't receive a credit for that 30%. So there's no franking credit there. So the company pays an additional 30% on that income. So you can essentially end up with 60% of tax payable on those business earnings, which is quite significant. Sorry, go ahead.
No. I was just going to say, it seems like they want to make everyone pay at least 30%, but in this situation, they're saying, well, as the penalty is 60%, so it's almost like the policy is we don't want people to invest.
That's right.
If you're actually putting the money into the corporate beneficiary, capital is flowing into share markets, capital is flowing into equity markets. That is good for a country. But you would want the idea is build the tax base. Grow the economy, which builds the tax base. Then you don't need to increase taxes as a percentage. This seems nonsensical.
Yeah. And to be honest, out of all the measures that have been announced, Stuart, my gut, again, don't take this with a grain of salt, but my gut tells me this is the measure that will be most likely wound back. And the reason is that trust law is actually embedded in common law. So it's not about just changing tax law, it's about changing common law too. And from my perspective, there's a lot to unwind here to get this through. And like we've sort of mentioned to clients previously, do nothing for now. You don't need to restructure your affairs. These changes won't come into place until 2028. And they're still giving us the 3-year grace period. So even if they do come into effect, apparently there's going to be some CGT provisions that will allow us to restructure your affairs so that you're out of this sort of trust structure.
Yeah, that's right. And the common law principle around trusts is they're look-through entities. A trust is just an agreement to hold assets on behalf of beneficiaries. It's not a legal entity in of itself. That's why it needs a trustee. It needs some legal person to hold those assets on trust. And they've always been taxed that way as look-through entities. Whatever passes through a trust, the tax nature is retained. So it is a massive departure from that approach. Let's talk about sort of two cohorts, Mena. I know it's far too early to react to these changes, and we do have plenty of time, if they do become law, plenty of time to react. But I guess let's talk through some of our thinking. And I think there's sort of two cohorts here. There's going to be self-employed people with trust structures that have taxable income profits from their business to distribute. And then there's the other cohort is really investors, people that have a passive investment vehicle, be it a trust with a corporate beneficiary or whatever it might be. So let's talk about those two. Let's start with business owners first. What are we thinking in terms of navigating these changes?
Yeah, so typically for business entities or people that are in active businesses, we'll most likely have them in some sort of corporate structure, so a company. And that company's shares will typically be held by a family trust. Now, to prevent the franked dividend coming from the company into the trust and into the beneficiary from being double taxed, what we could do is then interpose an entity before the family trust. So the shareholdings of the trading company are then taken place by the corporate beneficiary, which would have otherwise sat further down the line. So what that does is it allows you to basically still get money out of your company, pay dividends into it. So from an asset protection, you're reducing your retained earnings. There's no concerns from there. You can invest those funds still in a tax-effective environment, and then stream dividends out as and when you need it for personal living expenses.
And we of course haven't seen the legislation or the detail, but they do talk about CGT rollovers as a result of restructuring. So we would expect that we'll be able to rejig things without really upsetting anything. And the only change, Mena, then is sometimes we wouldn't distribute that much money or the maximum amount to individuals. We might only distribute 135,000 or something if we wanted to really optimise tax. But now, if we're going to distribute to individuals, we want them to at least have a 30% average tax rate. So that's sort of 190, 200,000. So that's really the only change. It's not ideal, but for self-employed people, most self-employed people, I don't think it's going to change too much. Oh, of course, actually, before we get to that, I should say that we've fixed the comments. So if you do have any questions, please post them in. We're getting towards the end of today's session, which is perfect timing to answer your questions. So if you do have questions and we haven't covered them, please put them in now. I guess, Mena, the only proviso here is that, for self-employed people that distributed outside the family group or the wider family group, that's probably not achievable anymore.
Yeah, because typically if you sort of distribute it to people outside the family group, they would have typically been below that 190,000 mark. So again, you're really sort of paying 30% tax on someone that would have otherwise been paying a lower marginal tax rate. So it's definitely not recommended.
Yep. The second cohort, Mena, are passive investment entities. So this is a situation where we're using a trust to invest in the share market, whatever sort of assets. What do we think with respect to that?
So you're probably in that sort of, if you recall, I mentioned that you can still use gearing for share trading. So, think of the likes of margin lending, but we typically like clients to use sort of equity against the home for more favourable rates and so forth. So you can introduce gearing into that entity, so you can start investing and get some tax deductions. Also through just consider moving investments into a company structure. So capping the tax rate if you're at the highest marginal tax rate, and also consider super. Getting more money into super, start investing more into super as well. You get the tax deduction personally. It's still in a tax haven. We'd like to think it won't get touched again for a little while. So yeah.
I think the other thing people can do is think about investment management as well. Like, what are they investing in? If I look at our portfolios over the last 3 or 4 years, they've generated about 1.5% in total return in income and capital gains, and about sort of 13% total return over that period. And I'm just going from memory, by the way, but. So we're investing in a way that's generating not a lot of income or capital on purpose. Ultimately we're focused on total overall return, but to reduce the taxation drag, we want less income and capital gains. So that's another way to sort of navigate it as well. And moving money into super is something we always think about, particularly if we've got a client and we want to have the flexibility to have assets outside of super. Particularly if we want to have the flexibility to staged or early retirement. But as we get closer to 60 and being able to access super, that's when we potentially move money out of family trust, subject to capital gains tax, of course, into if you're able to do that into superannuation. So I think there's going to be some changes here, like you do, Mena. I think there's at least going to be a small business income carve out. So that is that, people that are running a small business that aren't millionaires, that aren't then going to be in that example that you gave where the tax bill increases from 45 to 60,000. But actually, I wouldn't be surprised if this one got totally knocked on the head.
Yeah.
Because it does really change how trusts are being used and corporate beneficiaries. And the ATO was previously, in terms of its compliance operations, really focused about people misusing trusts. So distributing money, but not actually distributing the cash, saving the tax, going out and buying a yacht or a new home, doing these sorts of things. So, they're clearly, playing the tax system to their advantage, and that's what they were really after. I think this has too many negative unintended consequences. Yeah.
Definitely.
There's a question there, Mena. Gearing into shares, is that still attractive? Negatively gearing into shares. If we can't do it with property, what about the share market?
Definitely. As long as you sort of got a right investment philosophy, following evidence-based sort of investing, as we sort of bang on about day in, day out, sort of gearing to invest into shares is definitely a good idea. Wouldn't overgear though. Obviously, we all know that the share market is a lot more volatile than say brick and mortar is. So it's having a good sort of buffer or margin, as we call it, still definitely recommended.
Yeah, I've recorded 2 podcasts over the last, let's say, couple of months. I can't remember the episode numbers off by heart, of course, but one was around constructing an ETF portfolio. Another one was about lump sum share investing. So if you're thinking about using negative gearing in the share market, those 2 podcasts will certainly help. And it really comes, volatility is an issue, but it really comes down to what you're investing in, not necessarily just how you're investing. So if I'm investing in a sector of the market that's very attractively priced, probably doesn't matter that I'm going to put a lump sum in that market. But if I'm investing in a market where it looks overcooked or stretched on a valuation perspective, that's not ideal. I mean, I've got a question about valuations. Of course, if we're going to get assets revalued as at July 27, how's that going to work? Everyone's going to be looking for a valuation. And do you need a sworn valuation? Can you just ask a real estate agent, what does the ATO typically look at there?
Yeah, so typically we used to be able to get away with a agent valuation, quoting a range, quoting some sort of comparable sales around that sort of point in time. Now, I've recently had a review for one of my clients who disposed of a property where the ATO where we had an agent valuation, but the ATO actually asked for a sworn valuation. Now, luckily in that instance, the sworn valuation came in higher than the agent evaluation, so it worked in our favour. So I would generally recommend maybe obtaining a sworn valuation of some sort, or sometimes even if you're refinancing and you've got a bank valuation, you can get a copy of that bank valuation, and it's a favourable valuation, and might not be a bad idea to use either.
Yep, cool. There's another question about internally geared ETFs. I actually just finished writing an episode about investing super in internally geared ETFs, which was off the back of a question I got on YouTube. So everyone that posts those questions, they do take a lot of time to answer, but they do give me ideas. So I think that one's coming next month, but it's kind of interesting. Usually internally geared ETFs will actually reduce the income profile of the ETF, give you some leveraged exposure. So that's not so bad, particularly if it's in a family trust, because as I talked about, portfolio construction, trying to reduce the amount of income that comes off a portfolio. We also had a question, Mena, about, is using a family trust to invest in the share market still a good idea? This is one of these challenging questions, isn't it? I mean, do you make what is a long-term decision of something that, a rule that may or may not go through and may or may not be around for, the next 10 or 20 years? What's your view?
Look, my view is that there's another election coming, in 2 years' time?
2 years, yeah.
So a lot of this could get scrapped, and I wouldn't be surprised if it does go through and getting scrapped in a few years' time. So, we invest for the long term, right? So we don't buy a property today to sell tomorrow. We don't buy a share today to sell tomorrow either. We're here for the ups and the downs. From my personal perspective, I'd like to hear what you think, Stuart, but I'll sit tight. I'll still continue what I'm doing. I'll still be investing in shares, that is. I'll sit tight on the property front.
Yeah.
And see how things go. You could always do things, like we said, in terms of introducing gearing down the track. There's going to be things around the restructuring provisions down the track as well. So I wouldn't think that there's too much to do now, or we shouldn't be changing your investment appetite, other than property, that is, for the time being.
Yeah, I mean, you got the minimum, if we just assume everything goes through as it is, you're going to have to pay 30% on the CGT anyway. So whether you had that in or outside of a family trust, your only upside is that those rules are changed in the future. So therefore, the only downside to still using a trust is, will you pay higher tax between now and when you want to sell those investments? And that depends on the value of the investments in the trust and the nature of those investments in the trust. But if we can manipulate them to produce less income, then arguably I've got some optionality there. I'm in a tax environment that's not really going to punish me too much, and then I've potentially got the long-term flexibility if and when the rules change. And if there's a change in government, I would say that there's a very high probability of the rules changing, and I would say there's less than a 50% probability of these rules as proposed, as they apply to family trusts, of being legislated. I think substantially less than 50%. So let's not get too excited about it.
There's a good question here, Stuart, I didn't think about. Credit policies with banks and around borrowing capacity. Obviously, we've seen the bank share prices get smashed. I haven't checked today, actually, but yesterday the banks obviously all took a hurting on their share price. Do you think their policies will change when it comes to borrowing capacity and their appetite to borrow or lend funds to investors?
So, I mean, it's only been 40 hours since the budget, so it's a bit unfair, but we've had crickets from the banks. The banks haven't communicated about this in respect to credit policy, to mortgage brokers and their impact. I think they're probably still getting their head around it. I think it's really challenging for them. They've always included negative gearing in serviceability calculations. And now it's going to be a real challenge for them because they're writing a 30-year mortgage. Do you write that 30-year mortgage based on what you know today from a taxation legislation or what you think is going to happen in the future? What you're trying to do is assess a borrower's capacity to be able to service and repay that loan over a 3-decade period, not over the next 12 to 24 months. So I think it's a really difficult situation for them now, much like investors trying to make decisions today. I think they will probably be conservative and take negative gearing out of the calculation for now. But that's okay because I think the best thing for investors to do is do nothing right now.
Perfect.
Yeah.
We've got another question here. How does the new CGT proposal work for a pre-CGT asset, so a pre-1985 asset? So if you're one of the lucky ones that still have that kind of asset, you still get the tax saving up until 1 July 2027. So if you dispose of it between now and 1 July 2027, you're completely tax-free still. Post 1 July 2027, you'll need to only pay capital gains tax on the portion of the market value increase between 1 July 2027 and when you actually dispose the asset. So you'll get a valuation of whatever you're selling at that point in time.
Okay, look, just conscious of time. I would like to thank everyone for tuning in. Just a couple of apologies. The comments didn't really work that well, so apologies for that. We'll fix that. And as I understand it, YouTube serves some ads as well, which isn't ideal. We're certainly not making money off this, so that's not ideal. We'll know that for next time. I guess the thing we'll leave you with is don't do anything is probably the answer. Don't make any decisions. Don't make any changes. Let's just watch the debate. We'll drag Mena back for another presentation, once we know what things are going to look like, and we'll help our listeners, make important decisions and the decisions they need to make at the right time. But I'm sure there'll be plenty of commentary. There'll be plenty of self-interested commentary as well. So, look, just be careful. It's good to listen to different views. I'm certainly not saying that, but don't necessarily react off the back of one person's commentary. I think we want to see a consensus here. So we might leave it there. Thank you, Mena. Thanks for joining. You did show how excited you were about taxation, which is really worrying. But anyway, thank you. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.